Welcome back to the channel. As always, if you copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called Jefferies Financial Group. This is a company trading at $63, reporting earnings at the end of March. And if you haven't come across them, their financial services started more in the M&A space and trading and has become in recent years a bit more of a broader financial services organization. When you look at this chart right away, what you see is that over the last year or so, actually since the end of 24, the stock has been going sideways. And there is good reason for that. In terms of how they started the year, this, in my opinion, presents a bull trap for investors that are looking at getting exposure to the so-called or expected booming M&A markets. The reason for that is when you look at, for example, assets like PE, there has been a drought in terms of deal making. And as well, when you look at the public markets, there has been absence of substantial IPOs. But now the market is pricing overall, and this is quite prevalent if you see other indices, perhaps ETFs or benchmarks looking at the financial services sector, that this is coming to an end, but also that expectations for rate cuts are going to take place over the next few weeks. And look, I believe all those things are going to play out. Indeed, we are seeing some pickup in all those things. So you have Powell being subpoenaed and investigated, and you see as well massive dry powder in terms of private equity and deal making that needs to be put to work. But that is precisely why I think there is a disconnect between the valuation of this stock and what it actually can deliver. So when you look at the current valuation, you will see that despite the stock price having changed significantly, it has gone from 23 times to 15. So that's near half in just a few months, right? So when you look at it from a valuation perspective, the market is telling us that is nowhere near as excited or confident about this stock compared to just a few months ago. And the reasons for that, if I come back to the full thing, the reasons for that are first of all, around this time, I think it was over here in October, it was reported the fiasco of First Brands, which we'll touch in a second. But let's start a little bit earlier in terms of what's been happening up until that point. Management describes the current phase as a realization mode, right? So that's part of the reason why I'm saying that there is a bit of a disconnect between valuation and what is really going on at the company. So part of that expectations that we saw here in terms of pricing was driven by a period where the aggressive hiring of investment banking professionals and footprint expansion took place. So that happened between this period here, between 2020 all the way to 2024. Of course, after the initial shock, and even if we take the baseline, the all-time high up until before the COVID crisis, the stock went from below 20 all the way to 80, right? So what happened was that they saw Credit Suisse being taken over and acted or put together an expansion phase in order to fill that niche. as they thought that the tier where they sit in terms of size, which is basically competing more with not so large banks. So I mentioned Credit Suisse, right? But essentially not competing with JP Morgan or Goldman Sachs. They thought they could take that space that was left behind for them, but also because in terms of investor confidence, right, there was withdrawal, there was loss of confidence. And now, as we enter the year, management describes this phase as the realization mode after all that work that was put together, having those professionals expanding to new countries, opening new divisions. Now they are able to monetize that and capitalize on it. So this is where the rubber meets the road. They actually have to prove that what they've done works and they have to deliver. So that's the narrative that the stock has been on for quite a while. But if we look under the hood, the infrastructure that they've built does carry a lot of fixed costs that need to be absorbed and they need to be paid on top, right? So when you have a massive cost base and it is fixed, unless your returns are above that, you're going to be in trouble because then you're going to be stuck with high levels of fixed costs. And if your revenues or earnings are below that, then soon enough, you're going to be losing money consistently. So at the beginning, in terms of where they fit into the market, they were a mid-market disruptor, right? They had an equities franchise and a high yield bond trading capabilities. And then, as I mentioned, they embarked into this expansion, but that in terms of what it really took was described by their CEO as building another firm within itself. And that's what takes us to the cost part. So that building another firm within itself involved a 70% increase in managing director headcount in their investment banking and a geographical expansion into 60 countries. So we're talking about opening offices and so on. Now, when you look at the compensation of these professionals, a 70% increase in managing director headcount is huge, especially when you take into account that the compensation level for those professionals is one of the highest that can exist in one of these places. So the culmination of this strategy was supposed to be in 2025, which, as we can see, didn't quite work out, and also in this year. So the period where the jaws of operating leverage would widen, revenues rising, and the compensation expenses would be below what they deliver. But instead, late 2025 delivered a structural shock that exposed the risks inherent in their merchant banking DNA. And that was, as I mentioned before, the bankruptcy of First Brands Group, something that is not quite in the clear yet. I'm not going to talk about it. You can read about it if you want. Look up First Brands Group on Google. But you'll see that it was a massive fiasco that initiated a lot of questions about the stability of financial markets, particularly in the credit space. What's important here is to understand that this issue, this matter, revealed that Jeffrey's asset management arm was financing receivables for a company to which its investment bank likely provided advisory services. And that is a potential conflict of interest under the SEC investigation. So as we stand in January 2026, the stock is pricing a pristine cyclical recovery. So it's ignoring the regulatory overhang, the potential for client attrition in the asset management division, and the reality that the massive headcount expansion has structurally impaired margins. And this is probably why we're seeing this seesaw in terms of the price. So when you look at, for example, other companies in this space, you can see that there are all-time highs in a pretty much 45-degree line. In here, the hesitation is real. So that, in my opinion, creates a good opportunity for an asymmetric short trade. In terms of how they've changed their business model, they're no longer a simple agency broker anymore. They are a complex financial conglomerate. And that has attempted to reshape itself into a pure play investment bank. However, the legacy merchant banking risk appetite remains embedded in the asset management division, creating opacity that the market is currently mispricing. You just don't know if perhaps tomorrow there might be another first brand scandal. And of course, we could see some news from the SEC investigation, say a week from now, perhaps before the next earnings, right? And this is one of the reasons why I like this short. It's rich in catalysts. So some of the few things that we could see aside from that would be uh, the investment banking advisory, right, and underwriting. We could see this division being historically the largest driver of alpha in earnings coming, uh, at not great levels. The revenue on this is binary, right? The deal closes or it doesn't. And the current model assumes a massive uptick in deal volume to cover the increased fixed cost of the expanded MD roster. If the deal flow is merely good rather than great, then the EBITDA could suffer. And the fact that there is activity picking up and so on, yeah, that is risk, of course, to the upside. However, at this time of the year, I don't see how that might be happening by now, right? Because typically all the M&A flow happens by the end of the year. We're past that. Either we're very, very good news about it or something even just above expectations. I think the market will have caught a trend of that. Then we have the capital markets. So that segment comprises equities and fixed income sales, trading, and brokerage. That's a steady but lower margin contributor, and the business has shifted to algorithmic, so that requires massive technology investment. It is also highly correlated to market volatility. So we could have this as a play on the state of the market itself. Let's say that we have a long portfolio, but or even a short portfolio, but actually nothing happens, right? The markets just stay quiet for a few weeks. That provides us with a good hedge in terms of that the volatility is not there for a lot of money to be made. That provides us with a good buffer to account for that. I mentioned as well the asset manager, um, but I think all that wraps into their expectations and guidance, right? So let's say that when you look at management, they've been overall quite positive. They've guided well over 2025 as a transition year, or they said a year or of two halves, where H1 was marked by pauses and H2 was gathering momentum, which it did. But now the guidance for 2026 is actually bullish. Management claims that the wind is at their backs and that the firm has reached critical mass. So the guidance assumes linear acceleration in M&A. It could just be delayed. That's one of the risks that I see as probable. No contagion from first brands. That's out in the open. We'll have to see. And also immediate productivity from the vintage of 2023, 2024 MD hires, right? So that's pretty bullish, right, in terms of expectations. When you look at how that looks in terms of delivering, you're seeing here on a gap basis that this year is massive for them, but also next year. The expectations keep going up. They keep going up. The narrative, the numbers put forward by management are very bullish. So what if they just average? Or even if they disappoint a little bit, right? Analysts have largely adhered to this guidance. So the consensus view for 2026 projects is a robust recovery in EPS. And I mentioned before as well, the Fed rate cutting cycle. So with all those cracks in the dam, I think we could see at least some of them playing out. We could see, of course, if that happens, downgrades, a re-rating from Wall Street. That's something that has happened already in some firms. And even Jefferies own analysts are downgrading other cyclical names. So their macro call by their own research department implicitly argues against the very cyclical recovery that they need themselves to justify their own multiple. And of course, the previous quarter was significant as well. They actually missed on the EPS, right? And the market still is prodding along. So on a gap basis, right, they missed, but they remain at a similar level. So to me, that puts the stock in a fragile position in terms of a move. The market could just lose patience with this company. So of course, there are some risks to the upside. I mentioned some already, but one that I think could be the most probable out of all of them is the SMBC Capital Canon. They expanded the alliance with Sumitomo Mitsui Banking Corp, which is the central pillar of the bull case. SMBC intends to increase its ownership to 20%, and they've extended a $2.5 billion credit facility. So that lowers Jefferies' cost of capital and ostensibly provides them with balance sheet rental to compete with larger competitors. So that could be, out of all the risks that we're looking at, perhaps not the one that is the most probable, but certainly the one that's going to push the stock up the most. So that's the one to look for. But when you look at the headwinds, there are plenty, and they're quite strong as well, right? You have the governance and reputational discount from the first brands. If the SEC investigation uncovers something, that could be the start of something much greater for them. You gotta also look into the realities of all this increased headcount and how that could really, how all these individuals could mesh well together in an organization where they've been hired from other places. Not something that is always easy to do. In Q4, the results showed revenue up only 5.7%, despite of years of aggressive hiring. So the revenue per MD is likely declining, diluting the firm's efficiency metric. And also as well, if those things do happen and we continue to see a further macro deterioration, K-shaped recovery, it is likely that their clients, right, go to fortress banks, JP Morgan, Goldman Sachs, Morgan Stanley, and so on. So these guys could really suffer and even be left out of many opportunities. So with all those things, I'm looking at a put position. So I'll likely wait for confirmation for the stock to remain within this bearish channel that we see over here. But after that, I'll probably set up a calendar spread with puts on the 60 strike, long leg expiring in June and short leg expiring on March. Hope you enjoyed the video. See you soon.